The markets are doing what I expected, with some weakness today. But the big question is, will today be a turnaround day? Or are we headed further down? I'll explore the bear versus bull case, share some fresh perspectives, and consider what we learned from the recent FOMC meeting, and how that might influence the markets in the coming months. I'll also recap recent predictions and discuss some of my top trades.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
We'll start by looking at the S&P 500 heat map to see who's winning and who's losing. Right now, money seems to be flowing into healthcare and energy sectors. Today, Johnson & Johnson, J&J, and ExxonMobil are making gains in the market. Exxon has been in a channel between $118 to $120 for a while. While I don't have a strong opinion on its future, breaking above and closing beyond this channel could indicate a significant bullish run. Keep an eye on that $118 to $120 range. Now, let's talk about J&J. This is actually one of my investments in my long-term portfolio, and I'm quite optimistic about it. I believe it's gearing up for a breakout soon. I'm watching for a close above $174.50. In a previous video, I mentioned a trading range between $174 and $165.40. If we can close above $174.50, I think we'll head towards $180 shortly after. Now, let's dive into the broader market perspective. Are we still in a bull market, or are we transitioning into a bear market? That's the big question. Inflation and potential rate hikes are key concerns. The FOMC meeting notes reveal that the Fed is genuinely worried about persistent inflation and the impact of commercial real estate on banks. There's a looming bubble in commercial real estate, and when it bursts, it's likely to be worse than anything we've seen before. This could spell trouble for the banks, and in turn, affect all of us as it triggers a credit crunch that ripples through the economy. So, these are important factors to keep in mind. Let's dive into the market situation. There's concern that we might head into a recession. Looking at the S&P 500 chart, we can see some technical signs that things are not looking great. We've dipped below the 20-day exponential moving average, which is typically a bullish signal. Moreover, over 1,000 companies in the Nasdaq and S&P 500 have fallen below their 50-day simple moving average, indicating a significant pullback in the market's breadth. However, there are some bullish factors to consider. We had been on a 6-month bullish run, so a 2-month correction, even with an 8% drop in the S&P 500, is not entirely unexpected. Corrections usually involve zigzag patterns with both down and up days. The key marker to watch is the ascending wedge support line, which was discussed in a previous video. If we drop below that and close beneath it, we might start thinking about a more prolonged bearish trend. But for now, this correction could set the stage for buying opportunities, especially for stocks like Apple and Tesla, which have been pushed down to attractive levels. Alright, let's do a quick check on some recent predictions to see how they're holding up. Are we on the right track, or do we need to adjust our strategy? Let's talk about Hawaii Electric first. Yesterday, I advised you to sell every time the stock moved up because it was looking like a good short opportunity. Well, that call turned out to be on point. We were expecting this stock to drop back to historical support levels between $12 and $10, and guess what? It hit that range today. The drop has been pretty rapid, and it even touched the 4% level on the RSI, which is pretty low. So, if you see it dip to $10, consider that a chance to sell. The next support range to watch is between $9 and $8, and it seems like it's heading in that direction. This stock is oversold right now, and when it hits a really attractive price, I'll let you know it might be time to buy. But for now, it's all about shorting the stock, selling when it pops up. Now, let's talk about SoundHound. It recently hit $2.60 in just 2 days, but it's struggling to stay above the 200-day moving average and is sitting at the top of a descending channel I pointed out 3 weeks ago. If we compare this situation to the last time the stock dropped below $1.60 and then shot up to $5, we can learn a few things. Last time, it went up and then moved sideways and down for about 8 days before making a significant move back up. Right now, We're only 3 days into this recent upward movement. Even if it moves sideways or slightly down, we're looking for it to break up above that 200-day moving average and eventually reach the 50-day moving average, where we might consider taking profits. However, we need to be cautious. If this stock drops below $1.80, it changes the game plan, and we should let it go and wait to see where it stabilizes. Personally, I'm optimistic about this stock because it's in the AI sector and it's earnings season, which often leads to volatility and opportunities. I think we might see it hit $3 again. Still, we always need to be on the lookout for a breakdown. Anything below $1.80 would be a breakdown, and I wouldn't want to hold it beyond that point. Alright, let's talk about Tesla and what's happening with its chart. Over the past month, since July 19th, Tesla's been on a downward slide. It's lost $78 per share during this time, and it's down by 26% currently. Now, I believe we might be at a point where the trend could reverse, and here's why. Yesterday, I mentioned a candle pattern that made me think we might see a dip today, but I'm expecting the next few days to bring some green candles. However, it's essential to stay level-headed and consider where this could go if it doesn't bounce back. Given the 26% drop, that's quite significant, and it's a good spot for a potential rebound. If, for some reason, the market takes a different turn that I'm not foreseeing, and Tesla continues to fall, the next level of support is around $211. I'm not anticipating it right now, but we've seen Tesla move rapidly before. As for my own position, I entered into some call options when Tesla was around $222, and I'll be holding on to those, expecting the candles to turn green and aiming to make some profits. However, even if you're considering getting in today, and there's another short-term drop, don't be too alarmed. I believe we'll quickly climb back up, at least to around $245 in the next week. To gauge this, take a look at the RSI on the daily candlestick chart for Tesla. We're getting close to the oversold territory, similar to what happened before previous reversals. Additionally, check out the MACD indicator. We're currently at the -8% line, which matches the point where we've seen reversals before. So, I'm keeping a close eye on the MACD to flatten out and start curving upwards. It's been a fantastic opportunity to profit from Tesla over the past 6 months, and even if it does dip to $211, I'd personally load up on it. However, remember, this is not financial advice. Always make your trading decisions carefully. Let's talk about Apple's chart. Similar to what I predicted earlier this week, Apple has dropped down to the price point I expected. Even when we had that one green day, I mentioned it was a fake out, and we'd likely reach around $174. Today, we hit that point, which is right in my buy zone. Over the past 30 days, Apple has experienced a 12.44% pullback, which is quite significant for Apple. The volume today is relatively flat, indicating that the downward momentum is slowing. However, like I did with Tesla, I want to share the next level of support for Apple, which is at $172.77. If we go down further, we'll probably bounce from that level. For me, this is also a buy zone. Personally, I believe that by the end of the day on Friday, we'll see Apple's price around $176, which would put it back above the fib level, surpassing its previous local high. Remember, what was once resistance can now act as support. So, I'm expecting a turnaround for Apple, making this a buy zone for me. Just a heads up, I'm not expecting any significant upward fireworks for Nvidia. I think we'll mostly move sideways. I previously mentioned that $448 would be strong resistance, and I think it will continue to play that role. We might come up and test that price, but ultimately, I foresee a sideways to downward movement, hitting the ascending trend line I talked about weeks ago. In closing, one of the things that worked out well for us this week was patience. It always brings to mind my favorite Warren Buffett quote, though slightly paraphrased. The stock market is all about money transferring from impatient hands to patient hands. We demonstrated patience this week, and now we've taken a risk position in the market. We'll see if it pays off.